Welcome to the bustling world of the New York Stock Exchange, where investors execute over 1 billion trades in just a single day. But there's more to these transactions than meets the eye. Contrary to popular belief, Wall Street trades can take days to settle, involving numerous people and processes. Consider market makers, the vital middlemen orchestrating these trades. Remarkably, the top 5 market makers are responsible for nearly 30% of all trading activity. This intermediary role is essential in managing market volatility, but it also introduces gaps between buyers and sellers. The financial system is riddled with such inefficiencies. For instance, have you ever wondered about the prolonged duration of some bank transfers? This delay is indicative of the existing financial infrastructure's compartmentalized nature. Money and assets move along distinct and separate tracks. Banking giants like JPMorgan, Citigroup, and Goldman Sachs are at the forefront of advocating for a monumental shift in the American financial system. Their ambitious plan? To adopt blockchain technology, a key innovation from the world of cryptocurrencies, for tokenizing various assets. The transition to a digital-first economy is pivotal. As our financial landscape evolves, the ability to move money seamlessly 24/7, 365 in a programmable and always-on manner is becoming increasingly vital. Analysts at Citigroup predict that tokenization using blockchain could burgeon into a $5 trillion industry by 2030. This leads us to the pivotal question: why do these major banks believe blockchain technology can supercharge the financial system? And more importantly, can they successfully implement it? Tokenization in the financial sector isn't a novel concept. It's been a cornerstone of asset management for centuries. Traditional stock certificates, for instance, are essentially tokens symbolizing ownership stakes in a company. These assets, historically bare assets, could be transferred simply by signing and handing them over to the new owner, thereby transferring ownership. The advent of electronic trading and modern payment processors has significantly sped up the global financial system, enabling faster asset movements. However, Wall Street still operates on a T+2 system, trade plus 2 days to finalize the transfer of assets and cash. This delay isn't just confined to the realm of investment banking. Everyday financial transactions like ACH transfers and credit card refunds also encounter similar lags. This sluggishness is largely due to the numerous steps and parties involved in each transaction. For example, on Wall Street, brokers set up transactions and charge commissions. Market makers then connect these brokers to the assets they seek, earning fees on the spread between asking prices and purchase offers. Moreover, larger transactions undergo additional scrutiny for security and fraud prevention. Some of the largest banks are now exploring how tokenization on blockchains could streamline and potentially reduce the costs of trading assets. They believe that blockchain technology holds the potential to revolutionize and rewrite the rules of financial market infrastructure, encompassing the movement of money, securities, and other assets. Despite the volatility and fluctuations in cryptocurrency prices, the underlying blockchain technology is consistently recognized for its transformative power in reimagining financial infrastructure. Understanding blockchain is key to grasping the full potential of tokenization. Essentially, a blockchain is a comprehensive database of transactions. But what elevates it above conventional database technology? Several features stand out. Multiple copies of the database enhance security. Each block is cryptographically secured using hash functions, making tampering immediately noticeable, and a consensus mechanism ensures controlled updates. This technology is particularly advantageous where numerous parties require access to the same data but need assurance of its accuracy. With blockchain, disparate infrastructures can converge into a singular global system, facilitating seamless movement of value, assets, and information. This integration significantly reduces the inefficiencies and frictions prevalent in traditional financial systems. On a blockchain, every token, whether representing currency, property, or digital art, is part of the same ledger, shared transparently across various entities. One of blockchain's key attributes is its transparency, which potentially reduces the need for intermediaries, cutting down associated costs and due diligence efforts. Advocates of blockchain foresee its application in enabling peer-to-peer transactions across numerous sectors. They also envision innovative forms of ownership, such as splitting and professionalizing property ownership through real estate tokens, or facilitating instant money transfers through tokenized bank deposits. The versatility of tokens is another intriguing aspect. Depending on their design, tokens can be divisible, allowing partial ownership of tangible assets like houses or cars, or non-fungible, representing exclusive ownership of unique items like digital art. And let's not overlook the ultimate goal, tokenizing stocks and bonds. The IMF in February noted that tokenizing these assets could reduce trading costs, but emphasized the need for the currency used in transactions to be tokenized too, leading to the development of tokenized checking accounts for faster payments. Despite these promising prospects, a critical question remains. How feasible is the implementation of this technology on a large scale? Will the financial world fully embrace blockchain? And if so, how will it transform our everyday transactions? The journey towards fully integrating blockchain and tokenization in the financial sector is a gradual one, marked by experimentation and incremental steps. It's a transformation that won't happen overnight or even in a few years. It's a process of baby steps. For banks and asset managers aiming to stay relevant in the evolving financial markets, adopting blockchain and tokenization is becoming increasingly essential. A June 2023 report by Bernstein projected that over the next 5 years, we could see $5 trillion of real-world financial assets being tokenized on blockchains. However, previous attempts to integrate blockchain in traditional financial markets have encountered hurdles. Initial excitement in 2015 and 2016 eventually subsided, partly due to the heavily regulated nature of the financial industry where changes are inherently slow. Regulatory bodies like the SEC and the Treasury Department play a crucial role in this transition. The SEC, particularly skeptical of crypto and blockchain technologies following the 2022 crypto business collapses, has taken legal actions against major crypto exchanges like Coinbase and Binance. Meanwhile, the SEC is exploring other ways to expedite Wall Street transactions, such as moving to a T+1 settlement cycle by 2024. International attempts have also faced challenges. The Australian Stock Exchange abandoned its blockchain infrastructure plans after evaluations indicated the need for a significant overhaul. The complexity of market operations, involving numerous databases tracking transactions, presents both an opportunity and a challenge for blockchain implementation. Given these complexities, major exchanges like the New York Stock Exchange may be among the last to adopt blockchain technology. The key to widespread adoption of tokenization and blockchain lies in its perceived benefits and seamless integration into everyday transactions. Much like the effortless user experience of Apple's iPhone, the success of blockchain will hinge on its ability to provide a frictionless, always-on, and programmable financial service, without users necessarily being aware of the underlying technology. Remember to like, subscribe, and share your thoughts on blockchain's role in reshaping finance. How do you see this technology evolving in the future? Stay tuned for more insights as we explore the forefront of financial innovation.